Hi, everyone. I'm John Pokorova, the one of the leaders of the Boston IBD meetup. I just wanted to do a general market update. Back on November 12th, 13th, and 14th, my last update, things looked really, really good. But increasingly over the past 2 weeks, I've become more and more bearish. And some people have asked me to share what I was seeing at the time. So I thought that's what I would do today and give you my view. So I just wanted to start by saying that, everyone who is really in the market should be just doing a general market interpretation day by day. And I try to keep mine simple as possible. And I'm going to share with you some of the things that I do, and that if you put time into this, anybody can do this analysis. So the thing I look at the big picture. Where are we in the bull cycle? I'm going to show you some stuff about daily chart action in terms of distribution days and expectations at different points. I use some fairly simple breadth measures that I look at, new highs and new lows, and I'll share those. And then I want to always look at the leaders' action. What are they telling us? And the whole goal of every one of these analysis that you do is to try and assess what are the odds of the market going higher versus what are the odds of the market going lower. So I've just put my Twitter handle on the screen. Rain King at jpoco722. If you don't follow me, I encourage you to do so. I put out tweets not that often, but I try to make the ones I do meaningful. And the best way to share what I've been thinking over the past 2 weeks is I have been tweeting almost once a day or once every 2 days. So I'm going to take you through those, and that'll share where I was thinking and where we are in the current market cycle. So back on November 22nd, a week after my last video, I wrote, as a student of market history, I'm not saying the market's done, but it's following a big picture script for how bull markets top. Big caps can lead for a while. Tops are a gradual process, and I noted the 2007 example. So on the screen is the 2007 market top. And what I'm trying to show here is that the most speculative stocks will top out first. So your micro caps are topping out way back in June, small caps were topping out, then the mid caps, and then finally towards the end of the bull run, when the market top occurs, that's when the large caps, the NASDAQ, and the QQQs, NASDAQ 100, topped out. And there's quite a bit of lag. You'll notice 3 to 4 months of lag period between when the speculative names top till you actually have the large caps top. So shift this to the current market cycle. And this is our market today. And you'll notice that way back in February, the IPOs topped out. And also, the small caps topped out shortly after in March. And probably the #1 group in the market, which was the enterprise software group, actually peaked way back in February. You'll notice this pink line. This has been declining for many, many months. And even over the past 3 months has been making new lows. And that was the #1 group. Small caps broke out in late October, early November, but then they got quickly turned away. That was a bad sign. But as this chart shows, the large caps were still making new highs. Pretty classic example. So on November 18th, I had shared what I said was the first clue that something was wrong in the market. We had had about a 3% correction. I wouldn't even call it a correction, it's really a pullback. And then this next rally to new highs was showing things weren't all right. So what I was looking at, and I tweeted this, the NASDAQ new lows are rising on this rebound attempt. Maybe the 3% pullback was not enough. And the played out growth names were under heavy distribution, Crowd, C Limited, etc. And other growth stocks, Roku, Twilio, Snap had already peaked out back in February and March. And most recently, the IPO musketeers of Upstart, Affirm, and Applovian were also topping out and breaking down. So that was a big yellow light in my book that something is not right as the market is moving into new high ground. This shows a chart with the new highs minus new lows. And what I'm trying to show in this chart is as the market made new highs, we actually had negative new lows. Very rare occurrence and not a situation. You want to see your new highs expanding as the market hits new highs. So this was another clue that something was not right. It was also happening in the S&P. So the next major clue that something was not right was, we expected this rally to go to new highs and the market to continue to rally. But we had what I call a major expectation breaker. We expect the market to move high. It reverses very hard off the top and closes at the absolute lows of the day. That is the major signal that something is not right. And I had also tweeted on November 23rd a note about the new lows were expanding into the red zone and not in a bullish fashion. The NASDAQ up-down volume looks much better, but it's masking the weakness under the hood as the leadership in the market was really narrowing into big tech. And so I want to share with you what these slides were in the tweet. This is a graph of new highs minus new lows to get to a net number. And I had noted in the tweet that we are now in the range of serious concern. We had greater than over 275 net new lows. And you can see I've drawn this box. We had not been down into this range of almost 300 so new lows until the previous time was way back in the bear market of COVID and the bear market in 2018. The reason the 275 is kind of a trigger number for me is generally when you get down that low of 275 new lows, it's a red flag. And I've noted this is actually the dot-com bust in 2001. And you can see where we've gone below the 275. And in 09, we also, in 08, 09 was a critical level when we had the financial crisis. So it's a pretty good indicator that things are not strong in the market. So on November 24th, the NASDAQ recorded 4 Hindenburg omens in a row. I'll explain what that is in just a moment, and I did in the tweet. I also mentioned that Hindenburg omens are not always a disaster, as shown in the July 2019 case, which only turned out to be a correction, but sometimes they can lead to bear markets like they did in Q4 of 2018. So this is the NASDAQ in the September of 2018. And basically the Hindenburg omen is a bearish indicator indicating very, very poor breadth. It's a breadth divergence where some stocks are moving up while many are moving down. We don't have time today to go over all these rules, but you can read this and pause your video player to go over the rules. If you want more information, you can go to sentimenttrader.com or Google Hindenburg omen. That will take you to the sentimenttrader.com site and you can get a lot more information. But the point was, in early September, we had 4 Hindenburgs in a row, and the market tried to rally, and then we had 2 more Hindenburgs in a row, and finally the market started to break and came through the 50-day and had a very sharp 10% drop. The other thing that's noteworthy was the market was flooded with distribution days as this was occurring, and breadth was not good at all. So this past Monday, November 29th, I tweeted, Monday was a 2% gain in the NASDAQ. And it was some good action, but the market leadership, if you really look closely, was starting to narrow even further and become more news driven around the Fed and inflation worries, as well as the uncertainty of the Omicron virus. So the next rally, I said, is really important, hangs in the balance, be on your toes. So the slide that I had in that tweet, this is what I was looking at. We talked about the expectation breaker, and I said, here we go, we have this rally attempt now. This is last Monday. And I said, we really want to see the breadth improve on this rally attempt, or we could roll quickly on a reversal or a failure. So the concern was, even though we had that first rally day last Monday, new lows were expanding and clustering together, which is just a negative divergence, which was, again, a pretty big caution sign. So on Tuesday, November 30th, I put out a tweet and I referred to Justin Mamis. He is a He passed away in 2019, but he was a leading market technician. He's authored 3 great books you can Google. He also wrote a newsletter called The Professional Tape Reader with Stan Weinstein. He developed something called the Mamis Sentiment Cycle, and it talks about market tops. So the slides that I used in this tweet are the following. Justin Mamis talked about near tops, where after a correction, there'll be a return to confidence, and people will be very, very bullish. We'll get a pullback, people buy the dip, pushes the market, everybody's making money, everybody's enthusiastic, and then the market pulls back again. And the problem with this is the next rally turns out to be very weak and comes back down. And we actually break a short-term subtle warning, and then a little bit more of a shorter trend line that really becomes an overt warning. And people can't believe that the market is not marching higher. And then the cycle continues, and I'm not going to go through how bottoms and how psychology works at bottoms, but I wanted to focus on this yellow portion of the chart and show you 2 examples. This is the 2016 to 2018 market, and this is the 2018 top. So I've labeled, this is where the market had a correction, and its return to confidence was the psychology. The first pullback to the breakout level was buy the dip mentality. The market was pushing higher and reached all-time highs in late September of 2018. Then we had a rally that really sucked people back in on this pullback, and it failed. They had 2 little rallies, they failed, and we got this short-term trend line, and then we come back and we actually have more of an overt trend line break off the lows going back until July. And then the market really started to break down. What's important in the sentiment cycle is what was happening with the new lows. You can see here, new lows were increasingly rising, 198, 265, 560. Eventually, as the market fell apart into the bear market of 2018, there were over 1,000 new lows. So that's an example of how you would use the sentiment cycle. Now, let's translate this to the current cycle. So here's our market where we had a correction. We came out of that correction in early October, and we had kind of the return to confidence phase. The market started to move up and we hit all-time highs. The challenge was that, I really had this zone of new highs under close watch. So the first rally that was after that 3% correction immediately reversed. And the second rally has also failed as of last week. And so we've certainly gotten a subtle warning that the market is headed lower. And what is really noteworthy is the new lows. The new lows and the breadth of this market are much worse than the 2018 top. You can see where the new lows have been compiling up and getting larger, 273, 409, 554 as we peaked in the market. So just a really big breadth divergence. So on December 1st, which was last Wednesday, I put out a tweet that was fairly simple. It said the market leadership has gone from a narrow leadership situation to now a pinhead, as the new lows have expanded rapidly, and amid the uncertainty around Omicron, inflation, and the accelerated Fed tapering. And even the big tech stocks were starting to crack. Google, Facebook, and Netflix were below the 50-day. Microsoft and Amazon were below the 20-day. And really the last ones standing, AMD, Tesla, NVIDIA, and Apple. But the market was really narrowing. And if you go back, and this is a line chart of the NASDAQ for 2021, and I've just put on the chart where growth stocks peaked out, their high price for the year. And you can see in February, many growth stocks actually peaked and have never come back. Then you can see kind of in the summer months, Roku and Square and Nokia all started to peak out. And then most recently, we saw some of the IPOs, Asan and Upstart, Tilo, Docs, all peaking out. And then most recently, as the market made an attempt to go even higher, we had a stock such as Shop and Net, which was one of the big leaders, topping out. So again, classic cycle of a top being a gradual process. And the tweet I sent on Thursday, December 2nd, was the following. Here's how I see growth stocks if I were to draw a picture.
The speculative names were hit first, core growth names were hit next, and now they're coming for the generals. So if you imagine this as being the investing battlefield where, as an investor, people are throwing slings and arrows at you and bullets, and the frontline troops, as your army, are the SPACs, the IPOs, the speculative names, and they have been mowed down completely. Behind those are core growth stocks. These are our reinforcements, and these are your names like Crowd and SE, big winners, Shop, which is a multi-year winner, Square, Paycom, Docu. They've all been cut down at the knees and have completely broken down. And as I mentioned in the tweet, AMD, Netflix, Google, and Facebook were also continuing to break down. And my concern was there's just the last generals are NVIDIA, Apple, and Tesla, and there's no one left in our army to really protect them. And that it really was a case that running out of time. So we all know what happened on the 3rd of December. It was a very bad day in the market. But I just wanted to summarize that the analysis I showed is something that you can do if you just follow things day by day. Here's my Twitter handle. Again, if you want to follow me on Twitter. And I wanted to go back and kind of look at the real big picture and end this presentation on a positive note. And those of you who have followed me in the past few years, I use the super cycle concept from history to apply to today's market. And the historical super cycle I refer to is 1974 to 2000, which was a 26-year cycle where the market bottomed in 1974, ground its way higher for 10 years. And then the big driver where the baby boomers entered their peak consumption years in 1983-84. And that drove a multi-year bull market to the top in 2000. It was over an 815% gain in 16 years. But you'll notice that there are bear markets along the way. The 87 crash, the 1990 bear market, and the 1998 bear market. Now, if we look at the super cycle that I believe that we're in today, the super cycle began in 2009 with the financial crisis bottom. We ground our way higher for 10 years. Most people didn't think the market could go any higher, but the demographic driver is we have 84 million millennials that were entering their peak consumption years starting in 2019. And the oldest millennials actually turned 40 here in 2021. And so there's the potential, and I say that, potential that this is a super cycle that could last until 2035, because there's still 15-year window of peak consumption ahead for the millennials, where they'll be buying cars and houses, insurance, financial services, etc. So the point is, I believe the long-term picture is still very, very much positive. But you'll notice there are bear markets along the way. 2018, we had a bear market, the 2020 COVID bear market, and there will be bear markets along the way for the next 15 years. This chart is the NASDAQ on a monthly basis, a really long-term view. And the point of this chart was if you construct some very long-term monthly trend lines, the market could actually come back down to approximately the 11,000 level on the NASDAQ, which would be about a 30% pullback, and still be in the super cycle that I just mentioned. So the long-term picture is still very much intact. So I wanted to make sure that we talk about the long-term as we also navigate the short-term. So I wanted to share one more thing. The Boston meetup has typically monthly meetings. We're scheduling our December 15th as our next monthly meeting, and I'll be speaking about strategies for earnings season. If you're not a member of the Boston meetup and you want to attend, it's a Zoom meeting. Just go to meetup.com, search for Boston IBD meetup, and you'll see a way to reserve your spot for the Zoom meeting on December 15th. Look forward to seeing everybody. It should be a good, well-attended event. So with that, I wanted to say thank you. And I also want to say the market is challenging right now. It certainly warrants probably a larger cash position than normal, but let's see how this develops, whether it's a correction or if it's something more severe. We don't know yet. So be on your toes, and we'll see you soon.